3 months ago, a woman named Patricia walked into a mortgage lender's office with a credit score of 621. The loan officer told her what she already expected. Yes, she could get approved for a mortgage, but the rate would be painful, almost 7% on a 30-year loan. On a $350,000 home, that would mean more than $180,000 in extra interest compared with someone who had excellent credit. Patricia asked whether she could have 90 days to improve her score before locking in the rate. The loan officer smiled politely and said sure, but warned her not to expect much. Credit scores are slow. A few months usually do not change much. 93 days later, Patricia came back. Her credit score was 761. The loan officer even asked whether she had entered the wrong social security number. She had not. Patricia had simply learned about a part of the credit scoring system that most consumers never discover, a part that banks and credit card companies understand perfectly but have no reason to explain. That 140-point jump saved Patricia more than $215,000 in lifetime mortgage interest. Same house, same income, same person, different knowledge. What Patricia discovered was not a trick, a scam, or a fake dispute strategy. It was a real feature built into the way credit scores work, sitting in plain sight while the financial industry quietly benefits from keeping it obscure. Today, I am going to show you exactly what she learned. By the end of this video, you will understand why everything you have heard about building credit slowly is technically true but practically misleading. There is a faster path that the system allows, but almost nobody advertises it. Let me begin with why the usual credit advice keeps people stuck longer than necessary. The standard guidance says pay on time, keep balances low, do not open too many new accounts, and wait. Wait years. Wait decades. Let your credit age slowly, and eventually your score will rise into excellent territory. That advice is not wrong. It is just incomplete in a way that helps lenders enormously. Every month you spend sitting in the fair or good range instead of excellent costs you money. Higher card interest, worse auto loan terms, steeper mortgage rates, higher insurance in many places, and larger apartment deposits. The credit score tax hits hardest on the people who can least afford it, and the slow traditional path keeps them paying that tax for much longer than needed. Banks profit from this drawn-out timeline. A consumer with a 680 score who could have been a 780 customer is more profitable. They pay higher rates and generate more interest revenue. The bank has no reason to help them escape quickly. The mechanism Patricia uncovered involves authorized user trade lines. To understand them, you first need to understand how credit scores are actually built. Your credit score is basically a statistical prediction of how likely you are to default on debt within the next 2 years. The scoring model studies your history and compares it to millions of other consumers. It looks for patterns tied to default and patterns tied to reliable repayment. The biggest factor is payment history. Have you paid your bills on time? That makes up roughly 35% of the score. The next biggest factor is credit utilization. How much of your available credit are you using? That accounts for about 30%. Then comes the third major factor, the length of your credit history. That includes the age of your oldest account, the age of your newest account, and the average age of all your accounts. That factor makes up around 15% of your score. Most people think credit history length is just a matter of waiting. You open your first card at 18. You are now 30. That means you have 12 years of history, and there is nothing you can do except keep waiting. But that assumption is wrong, and that mistake is where the loophole lives. When you are added as an authorized user on someone else's credit card, that account's full history can appear on your credit report. The age of the account, the payment history, the credit limit, and the utilization can all be imported into your profile as if you had been on the account from the beginning. Read that again, because the consequences are huge. If your mother has a card she opened 23 years ago, has perfect payment history, and keeps the balance low, and then she adds you as an authorized user today, that 23-year-old account can show up on your credit report right away. Your average account age could jump from 2 years to 12 years overnight. Your total available credit could double or triple. Your longest account history could suddenly stretch back decades. That is exactly what Patricia did. Her mother had 3 credit cards with a combined age of more than 40 years, perfect payment history, and utilization under 5%. Patricia was added as an authorized user on all 3. Within 2 billing cycles, those accounts appeared on her credit reports. Her thin file suddenly looked strong. Her short history suddenly looked established. Her score jumped 140 points. Authorized user strategy is not a secret to people inside the credit industry. Mortgage brokers know it. Credit repair companies know it. Banks definitely know it. But it is rarely marketed to consumers because there is no profit in helping people leave high-interest purgatory faster. Another example shows how this works in a different situation. Marcus was 24 years old with a credit score of 589. He had made college mistakes, missed a few payments, and maxed out a store card during a rough semester. He was trying to finance a used car, and every dealer quoted him interest rates above 14%. His grandfather had credit cards going back to 1987, spotless history, combined limits over $60,000, and utilization under 3%. His grandfather added Marcus as an authorized user on his 2 oldest cards. Marcus never got a physical card and never touched the accounts. It was purely strategic. Within 60 days, Marcus's credit report showed accounts with 37 years of perfect payment history. His average account age jumped from 2 years to nearly 19 years. His available credit tripled. His score climbed to 697, which was enough to move him from 14% auto financing down to around 6%. On a $25,000 car loan over 5 years, that saved him nearly $5,200 in interest. His grandfather's 10-minute action online effectively transferred decades of creditworthiness instantly. Here is how to use this strategy properly, because the details matter. First, the account you are added to must be in excellent standing. Perfect payment history is ideal. Any missed payments will hurt instead of help. Utilization should be very low, ideally under 10%. The account should be old, and older is better. The credit limit should be high relative to the balance. Second, the primary cardholder must actually be willing to add you. This is usually a parent, relative, or very close friend. They are sharing the positive history on their account. In return, they are trusting you not to abuse any card that might come with the account. A lot of people are added as authorized users without ever receiving a physical card. Third, not every issuer reports authorized users to all 3 bureaus. American Express, Chase, Bank of America, Capital One, and Discover usually do. Some smaller banks and credit unions do not. Check reporting rules before relying on it. Fourth, the effect usually appears within 1 or 2 billing cycles after you are added. You do not need to wait years. Once the issuer reports it, the history imports fairly quickly. Fifth, you can be removed as an authorized user anytime, and the account will later fall off your report. That makes the strategy low risk for the account holder. If circumstances change, they can remove you. The size of the impact depends on where you are starting. Someone with a thin file and short history often sees the largest gains. Patricia had only 2 accounts of her own, both under 3 years old. Adding 3 accounts averaging 14 years old transformed the age profile of her credit file. Someone with a more established file sees smaller, but still meaningful gains. Even moving from a 7-year average account age to a 12-year average can add 20 to 30 points. Now you may be wondering whether this is actually allowed. The answer is yes, absolutely. The authorized user system is built into the credit scoring models on purpose. FICO and VantageScore both factor authorized user accounts into their calculations. The practice is legal and officially recognized by the credit bureaus. Why does this exist? Originally, authorized user reporting was meant to help spouses. One partner might handle the finances and open accounts in their own name, while the other partner had no credit history despite living in a financially responsible household. Authorized user status solved that problem by allowing the credit-building partner to share positive history. Over time, people realized the system could also help children, relatives, and other trusted people build credit. Credit bureaus have not seen much reason to restrict it because it reflects a genuine financial relationship. Some critics have argued it should be closed, but the credit industry has mostly ignored those complaints because changing it would create other problems. For now, the strategy remains fully usable. There are limitations worth knowing. Some mortgage lenders look closely at authorized user accounts during underwriting and may discount or ignore them, especially in manual review situations. Patricia's lender used automated underwriting, which accepted the score at face value. In some scoring models, authorized user accounts count less than accounts where you are the primary holder. FICO has adjusted its model over time to reduce the weight of accounts where you are not responsible for repayment. The effect is still real, just not as huge as it once was. You are also dependent on the primary account holder's behavior. If they miss a payment or run up a huge balance, your score can suffer too. That is why choosing the right person matters. A family member with decades of responsible credit history is ideal. Let me go beyond authorized users for a moment and talk about other parts of the credit system that most consumers do not use correctly. The second loophole is understanding when utilization is measured and reported. Utilization, meaning the percentage of your available credit you are using, makes up about 30% of your score. Old advice says stay under 30%. Better advice says stay under 10%. The real sweet spot is often between 1% and 3%. But here is what most people miss. Utilization is usually measured from the balance reported to the bureaus, and that is typically based on your statement closing date, not your due date. You can pay your card in full every month and never pay interest, but if you charge $2,000 on a card with a $3,000 limit, and that balance appears on your statement, you are showing 67% utilization. Your score gets penalized even though you are responsible. The fix is simple. Pay before the statement closes, not just before the payment is due. If you reduce the balance to $50 before the statement closes, your reported utilization might be under 2%. Your score could move up 20 to 40 points almost immediately just by changing the timing of your payment. That works within a single billing cycle. You do not need to wait months. Pay before statement close this month, and the updated utilization can show up on your credit report next month. The third loophole is credit limit increases and how powerful they are. Utilization is a ratio, which means you can improve it either by lowering the balance or by raising the limit. Most people obsess over balances and ignore the limit side. Many issuers offer credit limit increases without a hard inquiry. American Express is especially known for this. You can request a limit increase through the app or website, and they will often approve a meaningful bump using a soft pull that does not affect your score. Doubling your limit instantly cuts utilization in half. If you owe $2,000 on a $5,000 limit, that is 40% utilization. Raise the limit to $10,000 and you are suddenly at 20% without changing a thing about your spending. The math changes and your score improves. The best approach is to request limit increases on all your cards every 6 to 12 months. Each increase helps your utilization and raises your total available credit. Over a few years, someone who started with $10,000 in total limits might grow to $50,000 or more just by asking consistently. Banks do not promote this. They also do not like it, because higher limits can mean higher balances for them, but lower utilization and better scores for you, which means better rates elsewhere. Banks prefer limits that keep customers profitable. The fourth loophole is strategic account management, which many people get wrong. You may hear that closing old accounts hurts your score, so you should never close anything. That is partly true, but often oversimplified. What matters most is the age of your oldest account and the average age of your accounts. Closing a relatively new account can sometimes help your average age. Closing your oldest account can definitely hurt. The right approach is to understand which accounts truly matter and which can be removed without damage. That store card you opened 2 years ago for a 15% discount may not be worth keeping if it adds clutter and no benefit. Your oldest card, though, should probably stay open forever even if you barely use it. A lot of people keep every account open out of fear, piling up store cards and random accounts that do not help them. A thoughtful review of what to keep and what to close can improve your score and simplify your finances at the same time. The fifth loophole is rapid risk scoring, which most consumers have never heard of. When you are in the middle of a mortgage application, timing matters a lot. Normal credit updates usually take 1 or 2 billing cycles. Rapid risk scoring can update your file in days. Here is how it works. Your mortgage lender can request that the credit bureaus immediately refresh certain items on your report if you provide documentation. If you pay off a card and show proof, the zero balance can show up in roughly 72 hours instead of waiting for the next cycle. Consumers cannot access rapid risk scoring directly. It only works through a lender during an active mortgage process. But knowing it exists helps you time your credit moves well. Make the big improvements right before or during the mortgage process, not months before when the effect might fade. That short window can create dramatic last-minute improvements. Someone who pays off a $5,000 balance in the middle of the application can see the score update before final approval. Someone added as an authorized user can see that history show up in days instead of weeks. Used together, these strategies can move a score 50 to 80 points during the application itself. Before I give you the action plan, let me point out the mistakes that sabotage this process most often. The first mistake is choosing the wrong authorized user account. If the account has high utilization, it can hurt you. If it has missed payments, those negatives can import too. If the account is only 3 years old and you already have similar history, it may not help much. Be selective. The second mistake is applying for new credit while trying to optimize your score. Every hard inquiry can temporarily knock off 5 to 10 points, and a new account lowers your average age. People often undermine their own progress by opening accounts that work against the very changes they are trying to make. The third mistake is inconsistency with utilization timing. Paying before statement close only works if you do it every month. 1 month of high reported utilization can erase months of careful work. Put reminders on your calendar a few days before each statement closing date. The fourth mistake is impatience. These strategies can work within 1 or 2 billing cycles, which feels slow if you are stressed about an upcoming application. People give up too early. Trust the timeline and verify the changes after 2 full billing cycles. Here is a practical plan based on where you are now. If your score is below 650, the authorized user strategy may offer the biggest jump. Find family members with old accounts, strong payment history, and low balances. Ask to be added as an authorized user on 1 to 3 accounts. At the same time, address any inaccurate negatives through proper dispute channels. Pay any revolving balances down below 10% before your next statement closes. If your score is between 650 and 720, you are in the optimization zone where several small adjustments can add up fast. Ask for credit limit increases on all your cards. Adjust your payment timing to reduce reported utilization. Consider the authorized user strategy if you have thin history or a short file. Check old negative items to see whether they qualify for goodwill removal if you have since built a good record. If your score is above 720, you are likely fine for most purposes, but optimization still matters if you want the best mortgage pricing. The difference between 750 and 780 can still mean noticeably better rate offers. Focus on utilization timing, limit increases, and maintaining the strong habits you already have. No matter where you are starting, pull your free credit reports from all 3 bureaus every year and review them for mistakes. A meaningful number of reports contain errors, and some are serious enough to affect your score or loan eligibility. Fixing real errors is separate from these strategies and should happen alongside them. The deeper truth behind all of this is that the credit scoring system was built by lenders to measure risk for lenders. It was not designed to help you optimize your finances. It was designed to help banks decide how much to charge you. The system reveals certain things and hides others in ways that favor institutions over consumers. Banks do not talk about authorized user strategy because it helps you move out of their high-interest products faster. Credit bureaus do not push utilization timing because complexity keeps people dependent on monitoring services. The industry benefits when people believe credit improvement is slow, mysterious, and best handled by paid help. In reality, the scoring system is mechanical. The rules are knowable. Once you know them, you can optimize them. That knowledge has real wealth consequences over time. A person with a 780 score instead of a 680 score will generally pay less interest across their lifetime, get better mortgage rates, better auto loan terms, better credit card offers, and often lower insurance costs. Those savings compound for decades. These strategies work because you are using the system as it is actually written, not as it is casually explained. You are not cheating. You are not exploiting some broken glitch. You are using features that exist by design, but are not publicized by the institutions that profit from your lack of knowledge. Patricia's 140-point jump in 93 days changed her financial future permanently. The $215,000 she will save on mortgage interest can go into retirement, investments, and freedom. The knowledge she gained will affect every credit decision she makes from now on. And now you know it too. The loophole is not hidden because it is illegal or unethical. It is hidden because nobody with a profit motive wants you to know it. Now you do. What you do with that information is up to you.